Hey, my name's Rajesh. I am a direct lender based in Los Angeles, and today we'll be discussing a family, four-person family that earns, where the father earns $24,000 a year in Social Security. The mom gets $18,000 a year in Social Security. The son earns $30,000 a year, and the wife earns $20,000 a year. That's a total of, let's see here, 24,000 plus 18,000 plus 30,000 plus 20,000. So four-person family earning $92,000 a year. And we're going to figure out the most expensive home they can buy. They have about $60,000 saved up. And so I'm going to use this little calculator that I made to figure out how much home they can afford and the different ways they can do it. So let's say they just buy a single family home, no gross rents, monthly debts. They're pretty good with their credit. They all have 750 and higher, and they're all paying their credit cards off at the end of the month. Annual property taxes, let's say it is, I don't know, $6,000. Well, let's say 12,000 is a good guess. Annual hazard insurance is actually closer to $1,600. Interest rate would be closer to 6.375 right now. What happened here? Weird. Okay, there we go. Liquidity, they actually have about $60,000 saved up. And let's see here the maximum house they can afford based on this. So their qualifying monthly income, $7,667, almost $8,000 a month. Their total debts based on property taxes and hazard insurance are $1,133. That means their maximum mortgage payment, a maximum. So they might get a cheaper house and their payment will go lower, but as long as their payment along with mortgage insurance does not go over this amount, they're good. But if it stays less than this, they're even better because more money in their pockets for them. So their maximum mortgage payment is $65.33. Wait, that does not make any sense to me. Maximum mortgage payment is actually 46.99%. So let's see what that looks like. 76.67 minus 1133, that's 65.33 times 46.9%. Their maximum mortgage payment should not exceed $3,064. So that's a problem with this calculator. I'll have to go back and fix it. But let's see what that looks like in terms of monthly payments here. So let's see, once this thing decides to open up, I'll be able to pull up the actual max calculator. Turning it into a website is a little bit harder. So let's say they earn $92,000 a year, right? 92,000, zero in rents. And they're going FHA, other debts was zero, annual property taxes was $12,000, annual insurance was $1,600. With an FHA loan, their maximum front-end DTI is actually is actually 2462 at an interest rate of 6.0. So if we go 6.375, their max DTI or maximum front end P&I payments actually go down when you remove mortgage insurance from the appraisal. It's 2293. Let me scroll this part down, up higher so that you can see it. With the upfront mortgage insurance, you're looking at 6323. That's just something that's rolled into the loan on top of, and this is the maximum loan amount here. So that means their maximum home price is $381,000. So if you earn $92,000 either as a group or individually, the maximum home price that you can buy with a FHA loan at that income is $381,000. But now let's see what happens when you start getting rents. And I have a home here in Hawthorne that's going for $999,000. Let's see. This is a triplex. Fantastic. So let's say rents in Hawthorne for, you got the 3-bed, 1-bath, you got a two bed, 1-bath unit. So a 2-bedroom, 1-bath unit. Let's see what the average rents are over there. It says here $28.96 a month. I don't know about that. So let's see here. Average rents, Hawthorne, California. 2-bed versus 3-bed. So average rent is $19.95, but then they'll do a breakdown of bedroom types. So 2-bedroom here you can see is $23.95, and average rent for a 3-bedroom is $3,800. So let's say they decide to occupy the 2-bed, 1-bath in order to maximize their income, right? So they're getting $3,800 from one unit and $23.95 from another unit, and that's going to be multiplied by 75% to account for vacancies, maintenance, etc. So you've got, let's see here, 3,800 plus 23.95 times 0.75, 46.46. 46.46 times 12 is equal to, well, I don't even have to do that. This one takes it as monthly rents. So now their maximum monthly income, or their qualifying income, is $133,000. And look what that does to their maximum purchase price. It's $633,000, right? So with the triplex, they're limited to $633,000, and now we can actually focus the search here. So we can say anything less than $650, and nothing shows up. So let's see if we zoom out a little. And there we go. We see some multi-families for less than $650. So let's say they go Compton. Compton is not a bad area these days. Still got bars on the window, but this is a duplex, so that's not really going to help. This is a triplex, so this may help. Let's see what kind of rents this would bring in. So the front is a 2-bed, 1-bath, and then you've got 2 additional 1-bedroom units. So let's see what the zip code is here, 90003. here we go. Just choose another area. Average rent is $2,700 a month. Wow. That's even higher than Hawthorne. So 1 bedrooms are $1,795. 2 bedrooms are $2,395. So let's say they go with $2,395 plus $1,795. Actually, I just made a mistake. I used 75% of this as a rent, but this calculator already accounts for that. So let's see what it would look like at the full price. $3,800 plus $2,395 is $6,195. $6,195. And now their max price, you can see it went up to $718, and this is with an FHA loan. And they had $60,000, but their minimum down payment is $37,000. Let's say they go with a conventional loan, right? Now their max price drops down to $621,000, and that's because of the mortgage insurance that they had to pay right there. This right here, and with private mortgage insurance on a conventional loan, when you have less than 20% down payment or equity in the property, you have to pay private mortgage insurance. On an FHA loan, you have to pay mortgage insurance premium, which is still just mortgage insurance, but as a percentage of the loan amount on a 30-year fixed, you're looking at 0.55% per year of the loan amount, of the starting loan balance. Whereas on private mortgage insurance, you're looking at 1.75% of the loan amount paid, divided up over 12 and paid on a monthly basis. So that's why that affects the maximum monthly payment, because this would be counted as a mandatory debt towards the debt to income ratio. So that lowers the amount that can be contributed towards the principal and interest, and as a result, that lowers the loan amount. So if you look at conventional, the mortgage insurance is $879 a year on a house that costs $621 with a loan amount of $603. Whereas with the FHA loan, you're looking at a mortgage insurance premium of $317. That means your front end P&I is $43.23 a month versus, let's say, a conventional, which is $37.62 a month. With the VA loan, you're putting zero down and you have zero mortgage insurance. And as a result, your home price gets to be higher because 100% of your of the remaining mortgage payment can be dedicated to the actual principal and interest and not be split between principal, interest, and mortgage insurance. So we're going to go with an FHA loan here. And that allows for a 718 property. But what we see here, for example, this property right here is, this is a triplex. It's $449. So it's well below their max limit. It falls within their budget pretty fairly. And their income there would be $2,395 plus $1,795, assuming they split to 1 bedroom. If they just go with if they take the 2 bedrooms, they're going to get they're going to be able to rent 2 1-bedrooms at roughly $1,800 a month. So $1,795 times 2 is $3,590. Let's see if they still qualify. $3,590. So that means on an FHA loan, their maximum house price is $576, which means they do qualify for this $449,000 home, because that is cheaper than what their max loan amount allows. Let's take a look at another property. Maybe they don't want to go to Compton. right? Or 9003. Maybe they want to go someplace else. So what other options do they have? Because they're in the South Bay and they want to not go so far north. So let's see if there's any options down south here. And it seems like for triplexes, they're sort of limited to the northern part of the South Bay, close to downtown LA. Let's see what they have then. This one looks promising. 6 bathrooms, and for $500,000. Let's see what this looks like. This is a fractional interest probate sale, 6 units. So this is going to be a challenge because for owner-occupied properties, if you want a government-backed loan, a loan that will be sold to Fannie Mae or Freddie Mac, then it needs to be 1 to 4 units. So this one would not qualify, unfortunately. We'd have to do that as a DSCR loan. And that means putting at least 20% down. Let's see what this is. Okay, so this one is 4 units. It will qualify, but you only get 50% ownership interest in the property. You only get 50% ownership in the property. This is weird. I don't know why they would do that. It's called fractional probate, so I'm guessing the current owner is still holding on to it. And in this case, the owner would be the estate of the deceased, of the previous owner. This one might work. Let's see what this is. It says 6 beds, 6 baths. It's a triplex. 6,400 square foot lot. Not bad. Offering 3 separate units, each featuring 1 bed, 1 bathroom. So we can guess about $1,800 a month. Probably not the best. They'd probably each do 1 unit. So let's play that scenario out, right? So let's say they live there, right, and they collect $1,795 a month in rent from 1 unit, and their income stays the same. Their monthly rents go down to $1,795 a month, and each of them occupy 1 apartment themselves. So you got the mom and dad in one bedroom unit, and you got the son and wife in the other unit. And now their qualifying income as a whole is $108,000 because they're able to rent that third unit out for $1,795. So let's see what that looks like with an FHA loan, because that gives them the maximum leverage because neither of them are in the military. Conventional loan max purchase price would be $414. VA loan would be $495, but they're not in the military. So an FHA loan strikes a good balance and gives them a max purchase price of $478. $478. And let's see what this purchase price was. $650. So this is outside their budget. This would not work. Let's see what they would need to do to make it work, though. Okay. So how much would they need to earn in terms of rents in order to get it to work? $2,300 raise the max home purchase price to $506. Let's say they get it up to $2,600 a month. That's $522. $3,000. That's $544. $4,000. That's still just $598. $4,800. That's $642. Now we're getting closer. Are they going to get $4,800 even as an Airbnb? And just to remind you, as for FHA, conventional, and VA loans, they would not be using Airbnb income or formulas to qualify you. They would just use long-term rents. So even if you were able to get $4,000 to $800 a month as an Airbnb, it would be all for naught. They would just look at that $1,795 a month because that's what they could realistically get from that apartment. That's the market rate for a long-term rental. So let's see what this one looks like. This is also a triplex, 5 bedrooms and 3 bathrooms. So one of the units looks like it has 2 bedrooms, or 2 of the units would be 2 bedrooms, right? 2, 2, 1, yeah. This one might be interesting. There's a duplex, so no. This probably doesn't fall. That one does not fall within the budget. This is a foreclosure. So foreclosures are generally difficult to buy, and this says cash buyers only. 2 one-bedroom apartments upstairs and 2 commercial spaces. Now, on an FHA loan, you can buy on any owner-occupied loan for 1 to 4 units, you can buy mixed-use buildings. That means split between residential and commercial. It just has to be more. It has to lean more towards the residential side. So if you've got 4 units in a single mixed-use building, at least 3 of them have to be. Well, at least 3 of them have to be residential, and only 1 can be commercial. Now, let's say you've got a 2-unit building, right? A duplex, and 1 is commercial, 1 is residential. In that case, the residential space has to be bigger than the commercial space. So that's how that works. Here's one, $399, but they only show a drawing. So is this just architectural plans? Vacant lot with ready to implement or ready to issue permits. RTI, ready to issue. Here is a 4-unit, 90023, 590. So this is Boyle Heights. 4 one-bedroom, 1-bathroom units. Now this one gets interesting, because even though it's 590, let's see what the rents are here, right? For a 1-bedroom, 1-bath. Average rent, $2,515. 1-bedroom, 1-bath is also $1,795. So they're occupying 2 units, renting out the other 2. $1,795 times 2, $3,590. And the max purchase price they can afford is $576. This is $590. So this can easily be negotiated down depending on how long it's been on Zillow. And here we see that it's been on the market for 251 days. I'm pretty sure if they were to offer $550 for this, it would be a done deal, because they can qualify for this loan. So mother and father in one apartment, son and wife in another, and then renting out the other 2 units would allow them to qualify, even though individually their individual income is not much. You've got the father earning $24,000 from Social Security, mother earning $18,000, son gets $30,000 from his job, wife gets maybe $20,000 from her job and or disability, and that totals up to $92,000 a year. Plus the rental income is $1,795 per unit, or $3,590, almost $3,600 per unit. With the vacancy factor scheduled in, you're looking at a qualifying income of $124,000 a year, And let's see what property taxes would actually be on a $576,000 home. So 576,408.10 times 1.25% in California, and your actual property taxes would be 7,205, not 12,000. So that means their purchasing power just went up. As far as annual insurance goes, I put 1,600, but we can be very conservative and just say 2,000. So now their purchasing power went up even higher, and they get a maximum home purchase price of $633,000, which more than covers this price right here. So let's see what this looks like inside. And the reason I want to see what this looks like inside is because I want to see how many repairs does it need. And the good thing about this loan, about the FHA loan, even as a multi-generational home, is you can get the FHA 203K, and if you choose to go conventional, max purchase price is $547, still within that range, assuming they are able to negotiate a lower price. Let's stick with FHA for now. Let's say that property right here needs about, I don't know, $75,000 worth of work. Well, instead of going to the middle, let's say either $70,000 or $85,000. So let's say it needs $85,000 worth of work. So with the FHA 203K, it comes in two varieties: limited, which means repairs cost $75,000 or less, or standard, which means more than $75,000 in repair costs. It includes things like structural repairs, more than just cosmetic stuff like, say, paint and flooring. Paint and flooring is fairly cheap. Even on a fourplex, I doubt you're going to spend more than $75,000 doing it. But let's say this staircase right here was broken, or they wanted to update windows, or they had to bring some parts of the building up to code, like the furnaces weren't working, or there's some other violations with the city, then those could be very expensive to repair. And in this case, let's say it costs $85,000. So now we know their maximum purchase price is $633,000, and their maximum loan amount is $610,000. So all we have to do here is go to 633,080.02 and get rid of that $85,000 that they're going to spend on fixing it up. And now we know that the maximum purchase price that they can afford is $548,000. That's the maximum that they can offer on this place. So 548, almost 550, is not that far off from 590. And again, that's if they put the very bare minimum down payment of $32,000, and they have $60,000 saved up, so they can put a little bit more and be fine, because at a purchase price of $548, the maximum loan amount goes down, or rather the loan amount on that $548 goes down. So let's say times 0.965, because FHA loans have maximum LTVs of 96.5%. So we're looking at their loan amount would be, not counting the fix-up funds, just on the purchase price, would be roughly $528,000. So $528,000 minus 548, I don't know the other digits, but roughly 20 grand would go towards the purchase price, and the other 12,000 would go towards the 14,000. More like 13,000. Yeah, 13,000 would go towards the repair costs, because their maximum loan amount is $610,000. The maximum home price is $633,000, and that means when you combine the repair costs and the purchase price cannot exceed $633,000. And so what that means for them is that when after they finish repairing it, the property has to at least appraise for $633,000. So let's say they bought this property and it appraises for $650,000 after they repair it. So let's see what this looks like in 30 years for them, right? Let's see what this property looks like for the husband and wife in 30 years. So purchase price was $548,000. Property tax at 1.25. Let's go ahead and put in this link over here. Realtor commissions 3%. No need for property management because they're living there and managing it themselves. Closing costs are roughly 3%. Interest rate 6.875. What did I choose here? I chose 6.375, so let's go with 6.375. Loan term is 10 years. This says interest only. We're going to make this fully amortized. So now you see the balloon payment went away. Rehab costs. Loan amount was $85,000. Closing costs 3% because it's still part of the same loan. So all we really have to do is duplicate what's there. There's 30 years also. Yearly inflation. This is California we're talking about. So yeah, I see that this is already set up for California because the yearly appreciation is 8%. Yearly inflation 3.3%. I think it's probably closer to 4 or 5, but let's leave it there. Rental inflation, they say about 4%. Last video I did, I said it was at 3.18%, and they do a vacancy of 25%, so that's what we'll calculate here. And the projected ARV stands for after repair value. So after you finish repairing it, what's the future value going to be at the time of completing the repairs? So we said 650,000, right? So, and this is 4 units. Each unit generates $17.95, right? Now we're going to say 2 units here because we want to know what those 2 units combined add up to for them. And then hazard insurance is $2,000. Legal, let's say they have to spend evicting some bad tenants, cost them about $5,000. That's roughly $400 a month. Any common area like water, gas, electric? No, we're not going to include any of that right now. Let's see, pest control, advertising. And so their net operating income, meaning what they bring in, is roughly $19,000 after paying property taxes and insurance. And their debt service is roughly $46,000 a year, which means they have to pay $26,000 a year out of pocket just to stay there. But let's see what that looks like. 26,124.26 divided by 12. On a monthly basis, they're paying $21.77 a month as a family for 2 apartments. So if we were to divide that by 2, each of them has to pay $1,088 a month out of pocket just for their place to live. And you're like, big deal, so what? That's that used to be normal rents. Yeah, but now they're building equity, and I'll show you what they're going to exit with in 30 years. So, they're paying $1,088 each, right? And remember, the mother and father earn about $24,000 plus $18,000, so $42,000 divided by 12 is $3,500, and their rent comes to $1,088. divided by 3,500. So 31% of their income is going towards housing now. And let's see what the son and wife are doing. They're doing $50,000 a year. So 50,000 divided by 12 is 4166. 1088 divided by, whoops, my mind went blank for a second. 50,000 divided by 12, 4166. So 1088 divided by 4166 is 26% of their income is going towards living expenses. And as you can see, every year their net cash flow is negative, and they lose about $900,000 just paying the mortgage over 30 years. But you had to compare it to the rents that their neighbors are paying, which are $1,795 each. And they've not even increased the rents on the tenants. They're just going with what's market rate right now. What we see here is at the end of the 5th year, they were trying to sell the building. They're losing $22,000. But by the end of the 10th year, they would earn $200,000 on their sale, on their original investment. And that includes all the money they put into it, all the money that they paid toward the mortgage, all the money that they've spent on maintenance, etc. And by the way, this calculator calculates maintenance cost of 10% of the rents collected. And so they're paying about $269 every month towards maintenance. Now that doesn't mean that's what they're actually spending, but maybe they're just putting it into a separate account to save up for when a big repair is needed. And this is after they've already remodeled it, so the chances of something major going wrong is very small. But yeah, so let's see what it looks like if they decide to sell the property in their 20th year. They get $1.38 million. In their 30th year, they would get $4.4 million. And in their over the lifetime, if you look up every single year accumulated, they spent about $900,000 in terms of just servicing the loan on their end. And that's reduced by the fact that they were collecting rents as well. So they walk away with property that's worth $3.5 million. You cannot say the same for renting. So if you're a family, if you're a low-income family, and so let's say you're a low-income family, and this is your situation right here, where individually you're probably not earning much, but together you do earn a lot. If you manage to save up $60K, and relatively between 4 people, that's not a lot. That's $15,000 each. It can be done. Is it easy? No, but it can be done. You can purchase a property to live in and reduce your individual rental expenses as separate couples and get equity, build equity, and purchase a multiple 4-unit home while still providing housing to a community of people.